Welcome back. Owning a home is still the goal for many Canadians, but it's also harder and harder to do. Here's a look by the numbers. At 66.5%, fewer Canadians owned homes in 2021 than 10 years prior, when 69% of the population owned their home. There were steep declines in ownership in BC, down 3.2 percentage points, and Ontario, down 3.1. But the worst drop was in Atlantic Canada, a 4-point reduction in home ownership in Nova Scotia and a 4.6 percentage point drop in PEI. That, of course, has meant more renters. The growth rate of renters in the same period is 21.5%, more than double the rate of growth among those who own. Not surprisingly, that has increased the amount of rental stock. 40% of the housing built in the 5 years leading up to 2021 was rental housing. More than a third of those new units were occupied by millennials. Home ownership is definitely valuable. The net worth of Canadians with homes was $685,400 in 2019 on average. That's more than double the $323,700 net worth 10 years earlier. An increase in net worth is just one of the things that makes homeownership appealing. And while price and borrowing costs are making it harder, there are some creative ways to finance a home purchase. One of them on the market is Ourboro, an investment firm which will share in the down payment and future upside value of a home purchase. Alex Kjorven is Ourboro's Chief Product Officer. Alex, thanks for being with us.
Thank you for having me.
So let's start with how this works. You are willing to put up some of the money to make a down payment. You'll take some of the future price. Is it as simple as that? You become a part owner in the home?
Yeah, it's quite a novel concept. It is relatively new for Canada, the concept of shared equity. So Ourboro is a shared equity investment provider. And what that means is you got it. We contribute towards a down payment. And in exchange, we purchase a share in the future appreciation of that home. So the amount that we get in the future profit is all dependent on how much of the down payment we can contribute.
Is there a sweet spot in terms of what people already have for a down payment, what you're willing to contribute? In other words, do you have to be really in need for this to make sense, or do you have to have a pretty good sum already, which is sort of the right end of the spectrum?
Well, we know that saving for a down payment is one of the biggest obstacles toward getting into home ownership. In Toronto, the average family needs to be saving for close to 26 years, and that's making $250,000 in household income to be able to purchase the average price of a home. So many people don't have those kind of cash savings. For us, we say that our buyers need to contribute a minimum of 5% of the purchase price towards this transaction, and Ourboro essentially contributes the difference to get buyers to that minimum 20% required to purchase a home over $1 million.
And then, of course, whatever you contribute, that's the percentage you own in the home. You make your money, Alex, when the home is sold, presumably. Do you have any time horizon on that? Do you care how long somebody lives in that home?
Yeah, great question. So buyers can co-own with us for up to 30 years. At any time during that 30 years, they can sell the property. So Ourboro will never get in the way of you legitimately wanting to leave and sell the property, even if markets are down. During that 30 years, buyers can also offer to buy out Ourboro's share at that appreciated fair market value. So there's quite a lot of flexibility there for buyers. We know, though, that those looking for their starter homes are often in their first homes for no more than 5 to 7 years. And that's kind of our average prediction in terms of turnaround.
There is, of course, a scenario where somebody buys a house and doesn't make money on the sale, or the value moves against them while they're in it. What happens in that case when you have a stake in it? I presume that Ourboro's at the front of the line.
Well, that's actually, we're not. And because we are equity investment partners, our rights and risk and rewards are equal to that of the homeowners. It's the downside scenarios that makes our model quite unique. Because we're not a lender, Ourboro does not have priority rights in terms of recovering the proceeds of a sale. So if a property has depreciated in value, then we're at risk of losing our initial investment in the same way, in the same proportion that a homeowner would otherwise be. There's no guaranteed repayment for Ourboro, and that's a key distinction.
This is, as you say, relatively new. How much of this have you done so far in Canada?
So we've hit quite a significant milestone. Our product launched publicly to the market in the beginning of 2022. And since then, we received over 2,000 applications from qualified buyers. We've actually just reached a milestone of having 100 homes co-bought in our portfolio, which is significant if you think about this being a very new concept for Canadians. And those are learning that this is indeed a very viable option for those looking to break into the market.
And do you have a maximum amount that you're willing to lend out?
Yeah, so Ourboro will contribute that maximum of 15% towards a down payment or a maximum of 250, sort of the lesser of. In other words, if you're looking to purchase a home over 1.7 million, then you'll have to contribute more than the minimum 5% towards a down payment.
It's fascinating. Thanks for being with us, Alex. Really appreciate it.
Of course, anytime. Thank you.
Alex Kjorven is Ourboro's Chief Product Officer. Another innovation in financing some construction is the growing use of community bonds. In Hamilton, Indwell is hoping to raise $5 million in such bonds to support the development of 140 units of affordable housing. Nick Velde is finance manager for Indwell. Thanks for being with us, Nick.
Yeah, thank you for having me. It's wonderful to be here.
So let's start with the appeal of community bonds from your side. First of all, why go to community bonds versus some other source of financing?
Yeah, I love that question. Interest rate environments have changed significantly in the last few years. Also for us, any traditional credit facility that we have access to is typically more expensive than potentially the returns that we can offer with a community bond. And so with our Hope and Homes Hamilton community bonds that we're launching this week, we have the ability for investors to invest a minimum of $1,000 and then earn up to a 5% increase. And so there's a way to provide a financial interest to our bondholders and investors, while we also get a more cost-effective and affordable way of financing to really push new units into the market that is very much needed.
So 5% is a pretty decent return. Obviously, people could get more, but would we consider this a reasonably risk-free investment, Nick? Where would you characterize it for potential investors?
Yeah, I think anyone that is looking to make an investment into any type of investment facility needs to understand their personal finance situation, needs to understand the risk attached to those type of investment offerings, and also need to understand well what they're investing in. I will have to say that a community bond issued by our organization, by Indwell, has a high degree of diligence attached to it. The terms are 3 to 5 years. Again, 3.5% to 5% interest is what we can offer. And upon maturity, those dollars are paid back in principal to the investor. We are a very healthy organization. We have a $250 million balance sheet. We have a $36 million operating budget. We have about 270 staff. We now have 1,200 units across South and Southwestern Ontario, all the way from Mississauga to Simcoe, Woodstock, Hamilton, London, and St. Thomas. And then this year, Amanda, which is really exciting, we're celebrating 50 years of operation. And so what started in 1974 has really grown in such a robust, comprehensive format that I feel we're a wonderful organization to invest in. And I feel like we can, honor the due diligence required well.
So obviously stability, history, those things are all good. We don't have a ton of time, but you're building affordable housing. You're building housing for a vulnerable population. Does that make it particularly well suited to a community bond? In other words, it's literally your community that might want to also support this for other reasons. Yeah,
great question. I came to Canada 10 years ago from the Netherlands. I'm deeply privileged to be here. I've also seen my community, or the community that I call home, change significantly from a visible homelessness perspective. And I think many other people are in the same boat. I think that many folks are asking themselves, I want to be part of change, but I'm not quite sure how or even where to start.
Right.
The Hope and Hamilton Community Bond is that solution, is that place to start. And so starting at a minimum investment of $1,000, offering a 3.5% to 5% return, folks can not only get involved and align themselves to great social impact of more housing for folks that are suffering from chronic homelessness, and at the same time earn a financial return.
So good to have you, Nick. Appreciate your time.
Yeah, wonderful. Thanks so much for having me.
Nick Velde, finance manager for Indwell. Coming up, what the world's leading scientists have to say about taking on climate change. That's still ahead. But first, a not-so-sweet warning from some big players in chocolate. Hershey's and Cadbury's both recently said price hikes could be on the way for chocolate products as soaring cocoa prices start to hit their production costs. Cocoa yield has been hurt by erratic weather in some key producing regions. It continues a long march higher in the main ingredient for chocolate, just in time to cost the Easter Bunny a little bit more. We're back after this.